Hi everyone, thanks for joining us. I'm Sandie Menzies from Shoebox Books. I'm founder and CEO along with my friend Yvette, who's not here tonight. Let's get started on the webinar. So, Shoebox Business Basics, 5 biggest bookkeeping mistakes. Let's start with mistake number 1. Mistake number 1 is not setting up the chart of accounts properly. So a lot of your accounting software will ask you what industry you're in, and they will try and give you a set of accounts to use at the beginning. Try not to use what the software gives you, otherwise you'll end up with a very long chart of accounts, which you will not be needing. It will confuse you and you won't be recording things properly because you'll expect them to go into certain places and they don't go into those places at all. So most people don't need, or most small to medium businesses don't need a very large chart of accounts. So you should really make up your own chart of accounts or go to a BAS agent or tax agent and have your chart of accounts made specifically for you right from the beginning. So what we don't want to do also is to make a lot of accounts that you think you're going to track and then you don't go ahead and track them. So only make the accounts that you need to track. So for example, if you've got income accounts, you might sell 50 different products, but you only sell 5 different things. So you might sell envelopes, and you might sell paper clips, pens and rulers, say, but different types of pens and rulers. Some people without a lot of bookkeeping experience would go ahead and make 50 income accounts and try and track what you're selling that way. You're best to actually set them up in inventory items or even jobs to track them through there, or projects in Xero, and track your items through there. It's not a good idea to put them in your chart of accounts because it's going to become very bulky. And when you're looking at your P&L, you'll be looking at a P&L that's 10 pages long. It's not going to be very good for you, and you're not going to be able to track your items very well doing it that way. Make sure your GST codes are correct. Make sure your GST codes are correct. This will be especially important for you when you go to do your BAS. If you don't make your GST codes correct, when you go to do your BAS, you'll be going through and you'll be checking every single code and changing it, and preparing your BAS is going to take you a very long time. So please make sure your GST codes are correct. The other thing that I see a lot of people do is they double up on their items. So they might have printing and stationery. They come along and do an Officeworks order, forget that printing and stationery is actually there, and they'll make up a new account called Office Supplies. Then when they go and check and see how much they've spent on stationery for the whole year, they actually aren't getting the full picture because they've broken it up into 2 or 3 different accounts, and they have to look at all accounts to see exactly what they've spent for the full financial year. So make sure that you don't go ahead and start making up accounts willy-nilly. Make sure that if you are new to bookkeeping or you don't know what you're doing, get some advice in relation to it first, or print out your chart of accounts and have them in front of you so that you are checking your chart of accounts at all times. So that's mistake number 1 that I see. The chart of accounts is not set up correctly. Number 2 is setting up a petty cash account and assets. I've seen this so many times where people are trying to account for the cash that's coming in, so they're not putting it into the bank account, which is fine, or you've got businesses that are accounting for the cash that they've spent out of their own pocket for business expenses, also fine. However, you must understand that a petty cash account in assets is showing as you own something, or that the business owns something, and that something is actually petty cash. It's actually money that sits in a petty cash tin, and it's available there to spend. So when I was working in an office before FPOS and while checks are still, yes, I'm giving away my age, you would actually have a proper petty cash tin. You would get small denominations from the bank, so $2 notes, $5 notes, $10 notes, and if anyone needed petty cash to go and buy some milk or do whatever in the office, then they would take the money out of petty cash. They'd have to write out a slip, who they paid, what it was paid for, and if it was related to a client, then they'd have to attach the receipt to it as well. And then that would be accounted for in the petty cash account, and then you would draw a check for the balance and you would actually top up the petty cash account. So it's very similar, or basically exactly the same as a float that you would have if you're a retail store. That float goes back to just the change that you need to have in your cash register every day. So do not use petty cash to record your cash unless you are going to do a journal entry taking the money from petty cash and putting it into one of 3 accounts. 1, if you are a sole trader, it goes into drawings, which is an equity account. 2, if you are a company, it needs to go into the director's loan account. Or 3, if you are a trust, it has to go into the loan from beneficiaries account. They're the 3 accounts. So if you're going to use petty cash as an asset account, make sure that you clear it out. It should be 0 at all times, because you do not hold that cash in a petty cash tin ready to draw on whenever you need it. So that's one thing that really annoys me when I get somebody else's work and there's a massive amount of money sitting in a petty cash account and it sits in the balance sheet as though you've actually got that money sitting in your office in a nice little tin, but it doesn't exist. Number 3, not setting up your payroll correctly. So I'm going to spend a little bit more time on this because single touch payroll will apparently be compulsory by the 1st of July 2019, even though it's a compulsory right now if you have employees more than 19 employees. So this is what we see. Make sure you have your clients or your employees set up correctly. You must have a correct tax file number. I don't know if any of you know, tax file numbers actually have an algorithm. So Google tax file number algorithm. That tax file number, you can tell from the algorithm exactly whether that tax file number is viable or not, or if it's a made up tax file number. So a lot of the accounting software that is the latest versions will have that built in, so it will be able to tell you if the tax file number is dodgy or not right from the beginning. So this is one of the reasons why the government has brought out single touch payroll, because of the amount of dodgy tax file numbers that are given to employers, and we have absolutely no way of checking them except for the algorithm. Make sure your correct payroll categories have been set up. If you are a tradie, then you may have to pay people a tool allowance. You may have RDOs. You may have a car allowance, a phone allowance. You may have overtime. You might have overtime by 1.5 for the first 2 hours, and then overtime multiplied by 2 for any hours after that. Penalty rates. If you have shift workers, you'll have rates after 12 midnight or rates after 6 p.m. depending on the award. The next one is also the correct date of birth. You must have the correct date of birth in there because you need that information so that the ATO can match them along with the tax file number. When it comes to linking your accounts correctly, make sure that your superannuation is not linked to, say, overtime. Overtime does not attract superannuation, so you may be paying more superannuation than you have to. If your employees want to salary sacrifice their super, they're able to. It actually saves them in income tax. So those accounts need to be set up correctly. It's all in the background so that everything links to the right places. And also make sure that your pay-as-you-go withholding is separate from your superannuation payable. So your pay-as-you-go withholding payable is separate from your superannuation payable. A lot of software actually combines the two, and that's not okay. They need to be separated. So all of this is going to be especially important with single touch payroll. In a tax agent portal, if you are a tax agent, you are able to go into an individual, and if they have single touch payroll being declared at the moment, you will be able to see exactly what their gross payments are to date, their tax withheld is to date, and also the superannuation that should be paid to date. So the ATO are going to be using this information to make sure that super's been paid, to make sure that there's the correct tax file number, so you'll know immediately. Now this is going to come into effect in July. So you must, if you have employees, you must start making sure that you've got the latest software that can account for all these legislation changes. That's just the way it is. Okay, next one. Treating assets or liabilities as expenses. So you must know the differences between a balance sheet item and a profit and loss item. The balance sheet shows the assets less your liabilities. So assets are classified as anything that is over $1,000 and that is depreciable, that you keep and you own. So if you bought solar panels because you're an electrician and the solar panels cost $15,000, but then you're on selling them, then that is not an asset. That's just materials. But if you're buying a car that's more than $1,000, then that is an asset because you're keeping it. So it's very important to know the difference. I have seen people buying cars and putting them into the as a profit and loss item, which is incorrect, unless, of course, we've got the instant tax write-off at the moment. But usually it goes as an asset and it's depreciated over time. I also see people that will pay the repayments on the motor vehicle and they'll put the whole amount as an expense. The whole amount is not a write-off if you are paying off an asset. Only the interest amount is a tax deduction. So be very careful. It will give you a non-exact show of your profit and loss, which means that you may think that you don't have to pay tax because you've made a loss, where as a matter of fact, once everything is corrected, you may have a large tax bill. So it's very important to make sure that these items are put in the correct place. I've also seen people buying businesses and they put that business purchase in as an expense, and it is not an expense item. It is an asset because you can sell it. It's very important for the business purchase amount to be recorded, whether you paid for that out of your own funds or got a loan for that, because if you purchased a business for say $100,000 and you sell it for $200,000, then that $100,000 that you made is subject to capital gains tax. So it's very important to make sure that you're recording these amounts in the correct way. Okay, number 5, not reconciling properly. I have seen this many times, especially now that we have software that is supposedly doing the reconciling for you. Xero especially. So Xero says that it reconciles for you, which it does. However, you must check every single bank account to make sure that at the date that it's reconciled to is exactly what the bank statement says. Many people do not check this. They think that all the bank feeds are correct. However, the only bank feeds that don't have any problem are MYOB that I have seen so far. MYOB bought BankLink a few years ago. BankLink have been doing bank feeds for over 20 years. They have perfected it. However, Xero used a third party called Yodlee. They have not perfected it. QBO also use Yodlee and have direct agreements with many banks. They have not perfected the bank feeds. They don't always come through correctly. And in saying that, certain banks will drop out bank feeds from time to time. HBSC, Bank of Queensland, and Westpac, some of the Westpac credit cards are very notorious for this. So you will have lost days. So if you think that bank feeds are perfect, they are not. Make sure that you check. BAS reconciliation. Many people do not reconcile their BAS. If you have a tax accountant or a bookkeeper that does not reconcile your BAS, get a new one. I covered this in what your profit and loss is trying to tell you. What you've declared to the ATO as your sales figures must be what's on your tax return. It must equal 1/11th for the GST, unless you have GST items, or you can come up with a reason, and there are very, very many valid reasons, but you must know what they are, because the ATO will come knocking, because you will have a red flag pop up and you may be selected for an audit. Payment summary reconciliation is exactly the same. So your gross payments and your tax must equal what you've declared on the payment summaries that you've given to your employees to take to the ATO to get their tax returns done, and it must equal what you've put in your income tax return, which must equal what you have declared in your BAS. All very important. So you must know the right reports to generate so that you can check that everything is done properly and everything matches. The same with your superannuation reconciliation. You must check that enough superannuation has been recorded, or there's too much superannuation that's been recorded, because I've seen both. I've seen the superannuation is now at 9.5%. I've seen people not change the percentage of the superannuation. Some of them are still at 8.5% or maybe even at 7%. They haven't gone and actually changed the amount of superannuation that needs to be calculated because they're not using the latest software that's doing this automatically for them. So you must check that your superannuation is calculated appropriately for the year that you are in. And you do that by taking the gross wages and doing that. So they're my 5 biggest mistakes that we see at Shoebox, that our Shoebox bookkeepers are all trained in how to do and what to look out for. So basically what it all means is that everything needs to be set up correctly from the beginning. If you have any doubts, get your file checked before it becomes a problem. These mistakes take a lot of time and a lot of money to unravel, and that is because it goes to the grassroots. It's the foundation. These mistakes are the foundation. If you don't get your foundation right, then you're going to have a lot of problems with your bookkeeping. What problems you have with your bookkeeping is that you're not getting the correct data. If you don't get the correct data and the data that you need, you cannot drive your business forward. You're not really going to have a good idea of what your profit is, and you're not going to have a good idea if your business is valid or not, or what sort of tax that you're going to have to pay. In some instances, it doesn't happen very often, but it happens often enough. Our recommendation is that you just dump that file and we start again with a fresh file and we create the data again from a fresh file. Sometimes it's actually cheaper to do it that way than it is to go back and try and unravel a big mess. Okay, so if anyone wants a complimentary health check, let us know. We'll be more than happy to help. But otherwise, thank you for joining me tonight for our Shoebox Business Basics in the 5 biggest mistakes that we find in bookkeeping files. And we'll see you next month. Thank you.